Welcome to financial management class. Today we are going to look at the valuation of securities. Just a quick recap of what we covered in the previous sessions. In class 1, we looked at the introduction to financial management. So there we looked at the definition of financial management as being a process of planning, organizing, directing, and controlling. We looked at the objectives of financial management as being profit maximization and wealth maximization. These are two distinct um, roles that a financial manager should do. We also looked at the three roles that a financial manager does. The investment roles, which look at capital budgeting, to find the best possible value for a particular firm using different appraisal methods like NPV, IRR. You appraise different investments and picking the best of them all. We also looked at the decisions that a financial manager does, which encompass financing decisions where a financial manager is supposed to make decisions uh, on how to capitalize an institution. Okay. So we looked at what? Financing decisions, which look at how an institution is supposed to source what? Funds, be it in debt, capital, or equity. We also looked at dividend decisions as to looking at how to first best pay the owners. This is what we're going to look at on securities. Then later on, we graduated to looking at time value of money, which is the foundation for financial management. To say a quarter today is worth than a quarter tomorrow, because one that you get today ends more due to the interest rates. So we began by looking at the values, concept of future value, how to compute a value now to tomorrow, present value, how to discount a tomorrow value to now. And we concluded that the future value is bigger than the present value. And the formula for future value was given by future value is equal to present value 1 plus R per time. So this is a basis upon which we are able to calculate our dividends. So we also looked at annuities. To say annuities are periodic payments. These are periodic payments that are paid either at the beginning or at the end. So ordinary annuities are paid at the end of the period. For instance, rentals, if you pay at the end of the period, it is called an ordinary annuity. If you're paying at the beginning of the period, we call that an annuity due. So annuity dues, examples we looked at were insurance premiums, mortgage, lease payments. So these were very important. And we also looked at perpetuities. These are simply payments that you make forever. We also looked at two important interest rates, the effective annual rate and the nominal interest rates. So we labored hard to explaining the difference between these two. And we also looked at how these are evaluated, the present value and the future values. So this is where we ended. So now we want to look at the valuation techniques in terms of either debt and equity in terms of bonds. So this is one topic that we have looked at several times. So I want to be cautious of those that are beginners because this will be my last time looking at it. Of course, I'll use different questions in this case. So now, in terms of value of securities, we are going to So in terms of valuation of financial securities, so we said this is a fundamental topic in both financial management, money and capital markets, and also investment analysis. Because if you're taking any of these courses, this is resounding. You need to understand how to compute this. Okay. So the securities we're going to look at are bonds and stocks. Bonds and stocks. So we'll start with bonds, and I'll give examples of how to evaluate those ones. So I'll begin by explaining what each of these are. Okay, so I'm only going to take an hour to explain that. So in this chapter, like I said, we are looking at what? How to value financial securities like shares and bonds. How to value these financial securities like shares and bonds. So we'll look at the concepts of value of any security, the present value of expected cash flows. The basic principle we're going to apply here is the present value that we had in our previous session. So we will understand how to compute future cash flows based on coupon payments, based on dividends, based on redemption at maturity values. We also look at bond valuation, and bonds by definition are simply debt instruments that will pay you a fixed periodic coupon, and they will repay you the principal value. By the way, by understanding this course, you should also be students who endeavor to invest in bonds. So bonds have a certain way we calculate them. So the bond value is simply the present value of coupon payments plus the present value of the face value. So the coupon payments are actually treated as an annuity. So everything we'll be learning is based on the previous lessons we've had. But of course, if you are new, don't feel out of place. I'll explain all that. We also look at how to compute an ordinary share valuation. So we talked about investors who can either be called ordinary shareholders or preferential shareholders. So ordinary shareholders, um, is there a question? Yes, Shabanze, you raised your hand.
Sorry, I accidentally raised my
Okay.
hand.
So I'm giving an overview of what we're going to look at here. Okay, so the ordinary share valuation, we're going to use the DDM and the Gordon's model. And the preference share valuation, we're going to look at the perpetual fixed dividends. So a perpetuity, like we talked about in the previous session. Then distinction between intrinsic and market value and the yield to maturity concepts. So these are the key things that we're going to look at. So the theoretical part, firstly, we would understand to explain the general principle in security valuation. What is it? So the value of any security is simply the present value of all the future cash flows expected from it. So we are going to discount an investor's expected return to now. So when you are computing bonds, the cash flows or interest plus redemption value are discounted. When talking about shares, the cash flows of dividends and the resale value is also discounted. So today we'll call it what? The current value of a bond or current value of a share today. So this is linked to our initial class we had. So in terms of bond valuation, I'm going to take you through this example here of a bond whose face value is 1,000. So this question is from a textbook. Now, before I answer this question, I must mention um, the features of a bond. So a bond is issued at par value. It's a debt instrument that is issued by either government or a corporation. It has the following features. It has a par value, which we call the nominal value. It's usually in thousands, can be 1,000 kwacha, $1,000, and it will promise to pay at maturity. So it is actually a reference amount on which interest, which we call coupon, has to be calculated. A bond has a face value. Like in this question, the face value of the bond is 1,000. So this is called the face value or the maturity value. The bond also has a coupon rate, okay, which we denote as maybe small I. So the coupon rate is another feature of the bond, which is the fixed interest rate that the issuer will agree to pay periodically. It can be annually or semi-annually, or even quarterly to the bondholders. So in this example, 8% annual coupon rate on 10%. So the coupon interest is 10% of 1,000. The actual value is called the coupon value. The percentage form is the coupon interest. So our I here is what? 10%. So our face value is how much? 1,000. So when you multiply these two, what we're going to get is our capital I. Our capital I is simply when you multiply the coupon interest, small I, to the face value, which is FV. So small I, 10% times 1,000, which is the face value of the bond. What we're going to get ultimately is called the coupon value, the value of the coupon, which is 100. Then it also has the maturity in years. Maturity in years or maturity period. This is simply the gestation period of a what? Of a bond, the period within which the bond will mature. So the maturity date is the date upon which the principal or the face value has to be repaid. So a bond can be short term, up to 5 years, can be medium term, 5 to 10 years. It can also be long term, over 10 years. So the maturity period is the time gestation. The maturity date is the date upon which this bond will mature. So the issuers of a bond, I said, could be government, corporations, or financial institutions. These ones will use bonds to raise debt capital. So instead, it's ironical. The one who's issuing a bond is, in fact, the one borrowing money. So when government is issuing bonds, they are actually saying, we want money from you people. So we issue this bond, but we'll pay you with interest at a particular point in time. We also have the market price. The market price is simply the price at which the bond will trade in the market. It may differ from the face value. So if a bond price is, if the face value, for instance, is sold at a discount, we call it a discount bond. So if the face value is 1,000, as in this case, and the selling price of the bond is 900, so we call that a discount bond. But if the bond is selling for 1,200 and the bond, the face value, the original value was 1,000, so we're selling it at a profit, so it is called a premium bond. But if the bond is equal to the selling price and par value, we create a par bond. So these are the three bonds that you need to understand. However, a bond sometimes can be recalled before maturity when there's a call provision. So some bonds can be redeemed early by the issuer. So we call them callable bonds. So other bonds may actually be convertible, allowing them to be converted into shares or equity. Then also we look at yield to maturity, which is simply the total expected return if the bond is held until maturity. Okay, it accounts for both the coupon, income, and also capital gains. So I'll be as basic as I can be. So we say the value of the bond is given by what? The coupon value, which is capital I, times the present value annuity, PVA. We just learned about annuities. Okay? But I'll teach you a shortcut for those who missed on calculation of annuities. Okay, plus the face value times the interest factor, present value interest factor, the one we were calculating from the future value. Please watch my videos. So we're given a 3-year bond that has a rate of required rate of return of 12%. So this is our R. So find the value of the bond. So the value of the bond is given by the coupon value, the annuity factor, plus the face value and the interest factor. So these factors are the ones we're calculating in the previous class. How to calculate the interest factor? Interest factor is simply 1 over 1 plus R to the power time. We only use the market rate to calculate our interest factor. Okay, so in this case, we had what? Our required rate of return is what? 12%. So 1 over 1 plus R. So 1.12 to the power what? The time. The time is 3 years. So what is our interest factor? The present value interest factor. What do we get? 1 over 1 plus R at the power time. Anyone with the calculator quickly? Redeem time. What are you getting? So what is the interest factor? 1.1 over 1 to power. What are you getting? I hope you have calculators. I love a participative class. We get 0.7
Zero 0.71.
712. Okay. Then the present value annuity is simply 1 minus the present value factor divided by R. So the answer we got 1 minus 0.712 divided by our interest rate of what? 12%. 0. What? 12. Since it's 12%. Not 1 plus R, but R itself there. Okay. What are you getting? 1 minus 0.712 divided by 0.12. I don't have a normal calculator, but using the phone, 2.4. So what you're getting?
Yes, 2.4.
Okay, so we substitute. So the value of the bond is capital I, which is 100. How did we get the capital I? 100. It is a small I times the face value. The small I was the coupon interest. So coupon interest is multiplying what? 10% of 1,000. That's how we got this one. Then the present value annuity, we just calculated it is 2.4. Okay, then the future or the face value is 1,000. Then the present value interest factor, we calculated it 1 over 1 plus r to the power time, which was 0. What? 0.712. What are we getting? So we get 900 and what? 52. So this is the value of the bond. So what type of bond is this? Is it a discount bond, a par bond, or a premium bond? It is a discount bond because it's below the par value of 1,000. All right. Then we can also calculate the current yield. The current yield is simply the value of the coupon divided by the value of the bond times 100. Okay. So this is giving us 100 over 952 times what? 100. 100 divided by 952 times 100, we get 10.5%. So that is what we call the current yield. Are we together? So this is how we calculate the value of a bond. So I will take you through another example so that we are on the same page. Computation of bonds doesn't exceed that. You need to understand the concepts there embedded. All right, we need to understand that bond valuation, we have to have the parameters that have been given. So we're going to have this example from the exam paper. Okay, exam paper here. So number one, maybe I can ask you, what are some of the 4 features of a bond? Right, proceed. Any 4 features of a bond, not risk associated, 4 features of a bond. What are the 4 features of a bond? Explain them, anyone? 4 features of a bond. Number one, it has a maturity value, it has a coupon interest, it has a maturity date, okay? It's issued at par value. I explained all that. Okay, then let's look at part B. What, before we go to part B, part A is asking what are some of the risks that associated with bond valuation? What are some of the risks that are associated with bond valuation? The bond valuation is affected by risks of interest rate. Okay, So the risk that the bond may the prices will fall when the market rates rise. I think that's one of the challenges why most people who invest in bonds get to find that sometimes the real value of the bond is devalued by what? By the inflation rate. So the bonds with longer maturities are more sensitive to um, the rate changing. So if a bond pays, for instance, a 5% coupon and a new bond will offer 7, so its market value will drop. The other risk that a bond may have is what we call a default risk. A default risk. So a default risk, who can explain that? What is a default risk? A default risk, that's another risk that is associated with a bond. What is a default risk?
Let me try.
Mm-hmm.
Uh, I think this is when the issuer fails to pay interest or the principal amount.
Yes. A default risk is the same as a credit risk. It's a risk where the issuer will fail to make the coupon payment or repay the principal. So this one, the impact is that the lower rated bonds, which we call junk bonds, will offer yields that are higher to compensate for this risk. So for instance, if you have a corporate bond from a financially unstable company, it will carry a higher credit risk than that of a government bond. Government bonds are known to be more secure. The other risk that we may encounter is a reinvestment risk. This is a risk that the coupon payment may be reinvested at a lower interest if the interest rates decline. Then the inflation risk, the risk that inflation will erode the real value of the bond, like I mentioned. Okay, so let's look at this bond so that we calculate. Um, so we're given this bond, this came in your paper. A bond has a face value of 1,000 kwacha, a coupon interest of 10%, and the cost of debt of 12%. The time to maturity is 4 years. Calculate the value of the bond, 5 marks. So let's calculate the parameters. What have we been given there? Can you make some tea for me? All right, so we have our 1,000 kwacha, which is our face value. We have our 10%, which is what? Our small I. We have the 12%, which is our cost of debt, our R. And we have the 4 years, which is the time. So who remembers the formula for the bond? The value of the bond is given by what? Capital I, present value, annuity, present value annuity, plus the face value, then the interest factor. So interest factor, we can solve the interest factor separately here because these are very important, or the easy ones here. So the present value interest factor, who remembers how do you calculate the present value interest factor? 1 over 1 plus r at the power time. Are we together? And our r in this case is what? 12%. So 1 over 1.12 to the power what? 4. What are we getting? 1 over 1.1 to the power 4. Please be quick. What are we getting? Do we have calculators?
The answer is 0.6355.
Yes, 0.6355. That is our interest rate. And our annuity, our annuity factor, present value annuity, will be what? 1 minus the present value factor divided by what? R, right? So 1 minus 0.6355 divided by what? The R is what? 12%. 0.12. What are you getting? 3.0 what?
3.0375.
375. Okay. So now we substitute in here. How do we get the capital I? The capital I is equal to small I times face value, right?
Times the first value.
So what was our small I? 10%.
10%.
And our face value?
1,000.
1,000. So what becomes our capital I? 100.
100.
Correct. So on the annuity factor, what do we put? 3.037.
3.0375.
Okay. Then what is our face value? 1,000.
1,000.
And what is our interest factor? Future present value.
0.6355.
And what is the final answer when you compute?
939.25.
939.25. What kind of a bond is this?
Discount.
Discount bond, correct. How do you know it's a discount bond?
Because the value of the bond that we found is less than the face value.
Okay, there are three ways. The interest, coupon interest, is more than the market rate. It's a premium bond. Okay, so this is 10% is less than 12%. So it's a discount bond. So if the coupon interest is more than the market rate, it is a premium bond. But if the coupon interest is equal to the market rate, it's called a what? A par bond. Par bond if they're equal to. Then if the coupon interest is less than the market rate, we call it a discount bond. So here we have concluded that it is a what? A discount bond. Then how do we find the current yield? Coupon value over what? The value of the bond times 100. So in this case, we compute this as 100 over 939 times 100. So you can calculate the percentage there. So that is the current yield. Okay, so basically we have learned on the valuations of bonds. All right, during the day, we learned the evaluations of stock. So preferential shares, on the other hand, are like a perpetuity. So if you have a preferred share whose fixed dividend is $8 per year and the required rate of return is 10%. So you divide 8 over 0.10, that is 80. 80 quarter becomes the price of the preferred stock. I mentioned this during the day that preferred stock is like a perpetuity. All right, then tomorrow we'll look at ordinary share. Of course, I covered this during the day. Those that missed can watch my video. So we end here for tonight. I hope the class was insightful. You have a pleasant day.